Hey everyone, welcome back to the channel. Today we're doing a full, simple breakdown of one of the most legendary Canadian stocks of all time, Constellation Software, ticker CSU on the TSX. If you've heard people call this Canada's Berkshire Hathaway of software, that's not just hype. Constellation has built an insane long-term track record by buying boring, profitable software companies that most people have never heard of, and quietly compounding cash for years. But here's the catch, CSU is also one of those stocks that looks expensive at first glance, it's hard to understand, and the share price is high, so a lot of people either avoid it, or they buy it without really knowing what they own. So in this video, I'll break it down in plain English. What Constellation actually does. How it makes money. Why investors love it. What analysts think it's worth right now. And the real risks you need to understand. Quick disclaimer, I'm not a financial advisor, this is not financial advice, and you should always do your own research. I'm just sharing how I personally think about the business and the stock. Alright, let's start with the simplest explanation of CSU. Constellation Software is basically a company that buys other software companies. But not flashy Silicon Valley companies. They buy what's called vertical market software. That means software built for one specific industry, like software for car dealerships, municipal billing systems, hospital scheduling, school admin systems, property management, niche accounting tools, things like that. These are boring markets. But boring is good. Because in vertical markets, customers rarely switch. The software is mission critical, it's built into day-to-day operations, and switching is painful. So customers keep paying year after year. That creates recurring revenue, sticky cash flow, and high margins. Now, Constellation doesn't buy one or two companies per year. They do acquisitions constantly, and they've built a machine for it. They buy companies, keep them, improve them, and then take the cash those companies generate, and use it to buy more companies. That loop is the entire story. Buy. Operate. Generate cash. Reinvest. Repeat. And that's why people view it as a compounding machine. Now let's talk about the structure, because this is where Constellation is different from a typical roll-up. Many companies buy businesses and then try to centralize everything. They merge teams, cut costs, rebrand, and force everything into one system. Constellation does almost the opposite. They run a very decentralized model. They have operating groups, and those groups have tons of companies underneath them, and each business is allowed to operate pretty independently. Constellation's head office stays lean. They don't want a giant corporate bureaucracy. They want the people closest to the customers to run the companies, and they want managers to think like owners. That's one of their secret weapons, incentives and autonomy. Now, how does Constellation actually make money? It's pretty straightforward. Most of the businesses they own sell software licenses, subscriptions, maintenance, support, and professional services. A lot of that revenue is recurring maintenance contracts, subscription-like fees, hosting, and long-term customer relationships. So CSU is not one product. It's more like a collection of hundreds of small, profitable software companies across many industries and geographies. That diversification matters. If one niche slows down, it doesn't kill the whole company. Now, let's address the big question, why do investors love CSU so much? I'd summarize the love for Constellation in 5 big points. Number 1, it's an acquisition machine. Constellation has a proven playbook for finding and buying software businesses at prices that can generate strong returns. Number 2, the software is sticky. Vertical market software is the definition of high switching costs. Customers don't change vendors often. Number 3, they reinvest cash very well. A company can only compound for decades if management allocates capital intelligently. Constellation is famous for being disciplined with capital. Number 4, the model is scalable. They can keep buying companies. They've built a system and culture around acquisitions. And number 5, it's diversified. Instead of betting on one product or one industry, they own a huge ecosystem of niche software companies. Now, let's talk about the stock price and why CSU is a hot topic right now. Constellation has had a pretty major pullback over the last year compared to its highs. That matters because CSU is normally priced as a premium compounder. When premium compounders drop a lot, people start paying attention. And if you look at analyst expectations, you'll see something interesting. Many analysts still have targets well above the current share price. So let's talk price targets. Right now, depending on the source, you'll generally see analyst targets clustering around the low 4,000s per share. Some are higher, some lower, but the main point is this. Analysts as a group still see meaningful upside from where the stock has been trading recently. Now I want to be careful here. A price target is not a guarantee. It's not a promise. It's just a projection based on earnings expectations and what multiple they think investors will pay. But it does show you how the street is thinking about the stock. So what would need to happen for CSU to move from the mid-2000s back toward 4,000 plus? Usually, it comes down to two things: earnings growth and investor confidence. Earnings growth means the businesses keep generating more cash, they keep buying more companies, and the overall earnings base expands. Investor confidence means the market starts paying a higher multiple again, meaning investors believe the company's compounding is durable and the risks are controlled. So let's talk about the key engine that drives long-term growth: acquisitions. Constellation's entire model depends on buying companies at reasonable prices and generating strong returns on invested capital. If they can keep finding attractive deals, the machine keeps running. If acquisition opportunities dry up, or prices get too high, compounding slows. So one of the biggest questions for CSU long-term is, can they keep doing what they've always done, even as they've gotten so large? This is the main bear argument. Because when a company becomes huge, it's harder to move the needle. A $50 billion company needs a lot of profit growth to keep compounding at high rates. So how does Constellation deal with that? They do two things. They buy lots of smaller businesses, continuously. And they occasionally do larger acquisitions when they find something that fits. But their culture is still built around being disciplined. They would rather do nothing than overpay. That discipline is why people trust them. Now let's talk about the second engine, organic growth. People sometimes assume CSU only grows by acquiring. But their companies also grow organically through raising prices carefully, expanding features, selling to additional customers in their niche, and improving retention. Organic growth may not be explosive like a big tech company, but it's steady, and combined with acquisitions, it creates powerful compounding. Now let's talk about what risks could cause CSU to disappoint. I'll go through the biggest ones. Risk number 1, acquisition returns could decline. This is the big one. As more private equity and more buyers chase software companies, prices can rise. If CSU has to pay more, returns go down. Risk number 2, integration and management complexity. They own a massive number of businesses. Even with decentralization, there's always risk that some businesses underperform, competition increases, or management quality drops. Risk number 3, interest rates and financing conditions. Constellation can use debt at times. If borrowing becomes more expensive, it can reduce the attractiveness of acquisitions. Risk number 4, valuation risk. Even after a pullback, CSU can still look expensive on certain metrics. If earnings growth slows, the multiple can compress further. Risk number 5, leadership and succession. Constellation has a culture and philosophy that's been shaped for decades. Any shift in capital allocation discipline would matter a lot. Now, I don't say that to scare anyone. I'm saying it because CSU is not a no-risk stock. It's a high-quality business. But you can still overpay for a high-quality business. And you can still get periods where the market punishes even great companies. So how do we think about CSU in a simple way? I like to think in scenarios. Scenario 1, the bull case. In the bull case, CSU continues acquiring at solid returns, organic growth stays steady, and the market regains confidence in software compounders. If that happens, the stock could reasonably work its way back toward those low 4,000s price targets over time. Scenario 2, the base case. In the base case, CSU continues compounding but at a slower rate. Acquisitions still happen, but returns are slightly lower, growth is steady but not spectacular, and the stock grinds higher over years rather than ripping up quickly. Scenario 3, the bear case. In the bear case, acquisition opportunities become too expensive, organic growth slows, and the market keeps the multiple compressed. In that world, the stock can underperform for a long time, even if the business remains strong. Now, let's talk about why CSU is still special even if growth slows. This is important. Most companies, when they slow down, they don't have a reinvestment engine. Constellation does. They have a system that takes cash from existing businesses and redeploys it into new businesses. That's why investors treat it like a capital allocator, not just a software company. In fact, one way to think about CSU is, it's an investment firm that specializes in buying vertical market software companies. And that's why it gets compared to Berkshire. Not because it sells insurance, but because the main skill is capital allocation and compounding. Now, some people ask, does CSU benefit from AI? This is a modern question. And the simple answer is, AI is probably not something that kills CSU. If anything, AI can become a tool that improves the software companies they own. A lot of CSU software is embedded in workflows. So if they add AI features over time, automation, smarter reporting, customer service improvements that can improve retention and pricing power. But I wouldn't buy CSU as an AI stock. I'd buy it as a compounding capital allocator that happens to own software. Now, let's bring this back to the practical investor question. Should you buy CSU right now? I'm not telling you to buy or sell. But I can tell you how I would frame the decision. If you believe CSU can continue acquiring at attractive returns and keep compounding cash for years, then periods of weakness can be opportunities to build a position slowly. But because CSU is expensive compared to many normal stocks, and because it can be volatile, I personally think it's best approached with patience. Either dollar cost average, or wait for a valuation you're comfortable with. And don't treat it like a quick flip. This is a year's stock, not a week's stock. And one more thing. CSU's share price is high, so position sizing matters. You don't want one stock dominating your portfolio just because one share costs a lot. Now let's quickly summarize the key takeaways. Constellation Software is a Canadian company that buys and operates hundreds of vertical market software businesses. The software is sticky, recurring, and diversified. The company's secret sauce is decentralization, incentives, and disciplined capital allocation. After a major pullback from highs, analysts still see targets in the low 4,000s range, which suggests meaningful upside if the market re-rates the stock and earnings continue to grow. But the biggest risks are acquisition pricing, growth slowing as the company gets larger, and valuation compression.